Thank you. And thank you to the MMSteelClub for inviting me to share our views with you today. So I will kick off with the outlook for the precious metals, given the impact of COVID-19.
Good afternoon, everyone. Thank you for joining us. Certainly it's an interesting period of time, in particular hosting events such as this in the forum which we're doing it.
I'm ready when you are. Thanks. If we can just head to that first slide here.
Thank you very much. Thanks for having me here at the MMSteelClub. My name is Florian Grummis. I'm the founder and managing director of Midas Touch Consulting. Let's go into the chart.
I'm Chris Marcus of Arcadia Economics, former equity options trader, was running a specialist post on the New York Stock Exchange. Had my eyes opened quite a bit by what happened in the subprime bubble. Found it interesting that while Bernanke and Hank Paulson talked about subprime being contained in a perfect storm, no one could see. Everybody that did see it in advance that I found was talking a lot about gold and silver, which is what led me into that, and finding some unusual things going on that I don't think most folks know about and we can dig into today.
Good afternoon, and thank you for this great event that you guys at MMSteelClub is doing basically weekly, I believe. So I've been following very closely to, obviously I'm working from home. This is not easy, but it's a challenge, right? To work from home. Anyways, I've been enjoying your weekly events on zinc, on I believe on lead. It's coming up, and on aluminum market. And today I will speak on I will make my input on the issue of impact of COVID-19 on gold and silver market. I'll speak about gold because I focus on raw gold sector in Mongolia.
Great, thanks. Good evening, everyone. And thank you, Sonia, for the introduction, and to MMSteelClub for this invitation to participate in this webinar.
Good afternoon, ladies and gentlemen. I appreciate the invitation and glad to be here. Thank you for letting me participate in this webinar. I trust everybody is doing and keeping themselves well and keeping safe.
The precious metals obviously have been doing what they're supposed to do, which is generically act as an insurance policy and a hedge against inflation, disaster, uncertainty, and that, of course, we have in abundance. I'll show you on some charts what the relative performance has been of precious metals and equities and general equities, precious metal equities. So we're in an uncertain world. I think various forecasts for what will happen to economies in general are all, valid because nobody particularly knows. They can, if they're well-reasoned arguments, I think they're more or less as good as the next argument. We've never had something like this to fall back on. The Fed and other central banks around the world clearly have been printing money and ostensibly been devaluing their currencies. And of course, with gold being no one's debt, it is, as I said, doing what everyone is supposed to be expecting it to do, and that is function like a risk-free currency.
Here, basically looking at jewelry demand, which has sustained heavy damage over the first quarter of the year. Why is it important to look at jewelry demand? Because it's something like 50% of global demand for gold is jewelry related. And basically what we've seen is, because of the lockdown, because people can't access the market, we've seen a 40% drop in demand for jewelry to 325 tons in the first quarter. So Chinese jewelry demand dropped 65%, Indian demand 41% on a year-on-year basis. Also, interestingly, if you look at the more recent data for April, for instance, Indian imports of gold just collapsed. They dropped by 99.5%. I think roughly they import, usually in January, they imported 1.2 billion, and they only recently in April imported the equivalent of $3 million. So clearly, this has been an issue in the market, but it can be perceived as a bullish sign in that once we do come out from the lockdown, we will see demand for jewelry come back, which would be helpful and considered as a bullish factor. Also, central bank demand has also been hit, down 8%. The reason being central banks are busy fighting other fires. So central bank demand is roughly 8% of global demand for gold.
So if we look at the technicals in gold, the week before the Corona crash started, gold traded already at 1689. It then had a quick pullback, $150, and it made a new high at 1700. And then the stock markets really started to crash and drag down gold as well into a low of 1450 in mid of March. And since then, we have seen a strong bounce in gold and new highs in this move, basically new 7-year highs at 1747, and then 2 days ago at 1765. Overall, one could also argue that gold didn't really progress too much over the last 3 months, even though we had the Corona crash and even though the central bankers have been expanding their balance sheet like crazy. You also have to be aware that gold did already a big move before the Corona crash. So gold was coming from 1160 in August 2018. Now it's up $600, more than nearly 50% in the last 20 months. So this has been already a strong move. And what we see already over the last two months, basically gold is kind of like consolidating on a high level around the $1,700 mark. We had a breakout out of this wedge just a few days ago, and now it's trying to break through this resistance zone between 1740 and 1760. I'm not sure if it will be able to do this right now. Gold is entering a seasonal, more challenging time. Usually May, June, July is a bit challenging, and you usually get a pullback in the summertime.
Just to point out, gold, we had gold hit 1900 in 2011, and now we're the 1750 range. This is only the second time that's happened. So gold nearing its all-time high, more than double its 1980 high, whereas silver a third of its 2011 high. And if you'd be kind enough to click the next slide, you can see that it's even a third below its 1980 high, despite exponential more money printing, debt piled on, not just by the US, but by all of these governments. Meanwhile, the actual uses of silver have been growing. I believe Suki was talking about some of the industrial factors, which certainly have increased. I would imagine that has slowed down during Corona, but it raises the question of why in this current environment, when gold is coming close to its all-time highs, silver is still sitting there.
Gold is being regarded as a hedge instrument, we understand. It also as an investment instrument, as it was mentioned by Ms. Cooper. Silver is more on the industrial side, if I believe I understood you right. While gold is more an investment vehicle, an investment instrument, if you will. So in Mongolia, I focus on mining. Okay, so we've actually, when we look at gold, we first look at gold underground, and then we do the calculations and we figure out when we're gonna get the gold in the Swiss bank or in other banks, physical gold. So that's why we attract financing mostly to from zero, from A to Z, basically from the first drilling and trenching and drilling until we get physical gold. But so in Mongolia, we're not really affected a lot, honestly speaking. Now, people go to coffee shops, they have meetings already. Mongolia has been very lucky not to be affected heavily by COVID-19.
Similarly to impact on platinum mines, gold mines were also required to minimize operations down to care and maintenance with skeletal staff. Besides having an impact on actual production output, the South African mining sector accounts for 18% of the country's GDP. Additionally, the sector is also very central to the economy as an employer, tax generator, and source of foreign exchange income. So this in itself shows us the domino effect that the pandemic is having, not just on physical market supply and demand factors, but on an entire economy of a country. Mining companies have to deal with how to return to full operational mining while maintaining COVID-19 prevention measures. Although in South Africa we are extensively equipped and experience to deal with diseases such as HIV/AIDS and tuberculosis with screening and testing procedures in place. The COVID-19 screening and testing is different, as each employee will have to be screened before they go into a mine shaft. So this might only take a minimal amount of time per miner for a screening process, but on a cumulative basis could add a significant amount of lead time, translating into lost mining hours and reduced output, or an effect on mining output at least.
I would like to go over on the PGM market globally fulfilled demand for 2019. Basically, we estimated ounces we refined were total 17.5 million dry ounces. The value that I came up is close to $35 billion. Now, all of these metals are utilized basically with automotive, jewelry, air pollution control, petroleum refining, investment goods, and chemical. The metals are provided to the consumer through many supply channels. Very seldom a small amount is provided on directly, it's mostly indirect. The metals are sold from mines as main product from the PGM, nickel mining and platinum group, and that's sold through the recycling. Next slide, please. The geographical sources, why it is important that I like to discuss it, is that 80% of the PGMs are coming from South Africa and Russia. The balance is produced in Zimbabwe, Canada, and the United States from the mining side. Worldwide increase in unemployment attributed to COVID-19 is certainly going to impact the South African mining industry. I believe it's going to be not that easy that we all think. I estimate at least a 30% shortfall for the year 2020.
Well, I think that it's not terribly different than any equity investment. I think it's very difficult to be 100% correct, right? And I mean, you can have that conviction. That doesn't mean that you will be. So I think that the best solution on both entry and exit is typically a gradual entry and a gradual exit. Building a position over a period of time to try and average a price, and then the same on a sales basis, because you may be lucky and hit the right day on both an entry and on a disposal. We've seen a lot of volatility and a lot of violent movement. That makes it very difficult to time purchases for any one given trading session. So I would highly advise people to build portfolios slowly and similarly dispose of them slowly. If we're correct and the market has some months or years ahead of it, then sacrificing a few days to a week or so of either entry or disposal is not going to make a significant difference.
In fact, there's documentation that China since, I believe, 2009, Russia since 2004, are very well aware of the manipulation that the US banks are doing in the gold and silver markets. And gee, when you think, I don't know, if China realized that the US is not repaying any of the money, they're just tacking on more. I mean, gee, if they thought 10 years ago, maybe we should get out of this exposure, and you look at what they've done since then, certainly would match. I mean, you have oil transactions going from Saudi Arabia directly to China now that are circumventing the petrodollar. China's invented a petro yuan. If anyone listens to Putin speak, some of the things he says, I mean, he's not hiding it. He's talking about, we don't want to be dependent on the dollar. They abuse the power. In China and the US reaction in the last year with trade wars, and all right, I'm not saying Chinese government, I don't know about the Chinese government, but still the idea of that you're going to keep agitating your largest creditor It's a bizarre set of policies. I think the world is noticing it and is making arrangements to say, all right, we're done with that. And then now you have what's going on with the Fed. I mean, there's a lot of things coming together here now.
Yes, so the situation post-COVID, there is no doubt that rates, at least for a year, will need to remain at low levels to keep giving some cheap financing for the corporates. As I mentioned, coming out from the coronavirus, 2 months without, 3 months even without much demand for products has been building up. A lot of corporates have been building up a lot of debt. So they will still need some support even when, if we go back, assuming there won't be a second wave of COVID. But what I would say is, yes, there's a concern of corporate defaults, as I mentioned, high yields, probably at 12, 14%. Higher debts for corporates will lead to higher, lower ratings, higher cost of funding, lower employment by the companies, and lower in investment. So it does sound reasonable to say that rates will have to remain lower for a longer period to make sure that those companies are still able to access cheap credit. What I also mentioned about hyperinflation, and it's something that I would, because it's my point of view at least, and that of the bank, is we're not concerned about hyperinflation, despite the fact that there is a lot of printing money. We already seen 2010, and there was the same story about concern about hyperinflation, etc. But what we see and what we saw in 2010, again, I repeat, is we've been concerned about low inflation, despite the fact that we've printed trillions of dollars, the balance sheet have expanded. Inflation has remained low, contrary to what people have been pushing and promoting for the past decade. The fact is that the Fed has been lowering rates because inflation has been lower than what they wanted, than what they were aiming for. And so how come inflation we haven't seen any inflation, despite the fact that we saw and we're going to see helicopter money? It's because that money is not going towards consumption of goods. So you're not going to see it in the CPI. That money is going towards real estate and towards the stock market. And that is where I believe, and we believe, that the risk of a bubble as a result of that cheap money or helicopter money will be again in the real estate market potentially, which we've seen over the past decade, be it in Europe, be it in the States, go up rapidly, and also the stock market.